Chitra mentioned, none of what I'm going to speak is anyway new to any of y'all. I'm sure you already know of it or you've heard of it in some sense. What I'm going to do is more of a refresher and always a pleasure to kind of interact with seniors and lovely to be back. So with that, I'm going to open a small slide presentation. You know that I don't know this by heart, so I have to read before I kind of speak to you. So I'm going to share my screen so that all of us can be on the same page. So here is the topic that we had discussed and was the best government schemes for senior citizens, Indian senior citizens. That's really what we're going to talk about. There isn't a whole lot, quite honestly. I mean, while there are a few, there isn't a whole lot, but whatever is there, we just wanted to make sure that all of us knew about each of those options that are there, and so that we could make informed decisions as and when we needed to. So that's what I'm going to talk about. Now let's understand, why do we need these schemes? So one of the fundamental premise of retirement is that you want to kind of start enjoying a certain amount of cash flows every month, irrespective of having to manage it. So you want it to come to you in a very passive manner, not to have to kind of work or do some trading or whatever be that to make things happen. So the requirement is to generate a passive cash flow. Idea is also to be risk-free. As we get older, our risk appetite comes down. So there is a certain amount of money which we don't want to kind of put to risk, and which are reasonably secure, and as I said. So when we look at all these, then there are a bunch of, obviously, the reason why we believe government schemes are risk-free, one of the biggest reasons is that government can never run out of cash. Yeah. Because they own the printing press. At best, they can print their currencies, whatever they want. Right? So that's the difference between you, me, and the government. Because the government has that ability to print currencies. So fundamentally, they cannot go bust. So they are exceptionally safe from that perspective. So I just want to kind of quickly check how much of money per month would each of you like to get on a month-on-month basis? Just a quick question, you can put it in the chat box, or the bare minimum that you want on a safer note, right? So I would want more, but from a safety perspective, for my dal, roti, chawal, the basic needs, how much can I get per month? So yes, absolutely. For each of us, that number differs, right? So the point which I'm trying to make is that basic number that I need to come month on month, irrespective of whatever happens, is a number that is a little different for each of us for a variety of different reasons. We're not going to go into that now, but so I'm going to move ahead and see. Each of you have put some numbers, but I am going to start dive straight into some of the government schemes that can enable us to reach as close to those numbers that some of you have mentioned. The first scheme that I want to kind of talk about is this Pradhan Mantri Vayu Vandana Yojana. This is a government guaranteed scheme that is kind of managed through the Life Insurance Corporation. Eligibility criterion is that the Indian citizen must be above the age of 60. Yeah, and like I said, the scheme is actually not by LIC. It's managed by LIC, but the government of India is the back end. So from that perspective, it's an extremely safe investment. I mean, LIC itself is reasonably safe. It's a large institution, but even beyond that, this is actually not LIC's managed funds. It's a government guaranteed scheme. So irrespective of how the funds are managed, government at the end of the period will guarantee the return of principal. So the policy term is a fixed term. It's a 10-year period. So the moment you enter, you know that you're there for a 10-year period. and at the end of 10 years, you will get back the amount that you've invested. That's it, period. And if something were to happen to the applicant in between, the beneficiary who's named in the policy will get the repayment of the principal amount. No change in the principal amount. Principal amount remains the same. Mode of payment, there are 4 different options: monthly, quarterly, half yearly, annually. Of course, like I said, the minimum amount is much smaller. The maximum amount, there's a cap on the maximum amount. It's not an unlimited amount. The maximum that an individual can invest in this is 15 lakhs. Right? So there is a max cap on this investment that an individual can invest. So that's about 15 lakhs. The current rate of return that is offered is at about 7.4%. And since this qualifies as a pension from an income tax perspective, it will be counted from a taxable perspective. So it comes under the tax slab, so to say. The policy allows in terms of an emergency to take about 75, although like I said, it's locked for a 10-year period. You don't have access to the principal amount. In case of an emergency, 75%, up to 75% of that number which you've invested can be availed of as a loan, so to say. So, in case of emergency, there is some liquidity, but that liquidity is more in the form of a loan rather than as a redemption opportunity. Of course, there is an exception case for surrender, but I have not heard of anything in that sense. So this is the broad number, right? So on a 15 lakh investment, you can enjoy a monthly cash flow of about 9,250. So when you put your 15 lakhs into something like this, you can be rest assured that for the next 10 years, that is 120 months, you will get 9,250 rupees. The interest rate at the start of the policy is guaranteed through the 10 years. So for the next 120 months, you will enjoy this 9,250, and then the money will come back to you. And then at that point, if this policy or if this plan is available in the same form or format, you can always kind of do another investment there. So the first one is this Pradhan Mantri Vayu Vandana Yojana, which is, like I said, is instituted through the Life Insurance Corporation. You can only buy it from LIC, so you can reach out to your nearest LIC office or an agent if you know, or so on, and they can kind of guide you and help you. Sanjay has this question: how many schemes are we allowed to participate? An individual can only invest in one Pradhan Mantri Vayu Vandana Yojana. You cannot invest in multiple schemes that way. So only one you're allowed to. Also, you can invest one Pradhan Mantri, one senior citizens, and so on and so forth. So what I'm running through now is a series of different schemes, and you're allowed to participate in all the schemes if you want, each one. Right? So the senior citizens is a very similar scheme to Pradhan Mantri for senior citizens that can be availed through some authorized banks or even post office. And again, the age limit is 60, or the retirement. If you have retirement documents with you, that also they allow. Or it has to be the age of 60 years. And this is a much shorter duration. It's a 5-year scheme. Can be extended for another 3 years if it is intimated to them in advance, or up to 1 year. The mode of pension payment is quarterly. There is no option of annual or monthly, as the case may be in the Pradhan Mantri. Again, the maximum investment is restricted to 15 lakhs. Minimum, of course, you can do right from 1,000 onwards. So this is reasonably. This is an older scheme to Pradhan Mantri, so it wasn't created with so many different options as the other one is. There are fixed interest payment dates: 31st of March, 30th June, 30th September, and so on and so forth. The current interest rate, incidentally, for this scheme is also 7.14, 7.4. So government is trying to kind of keep some parity in saying that between this and that, the rate is very, very similar. The TDS will be deducted unless you submit Form 15G, 15H in this. And The scheme has a nomination option, and in the event of the first holder or the person not being there, the money will pass on to the nominee, as the case may be. But the scheme cannot continue, given that it's a senior citizen scheme. If the holder is not senior citizen, it cannot continue thereafter. So the principal amount will get repaid back to the next of the kin.
Excuse me. So, is there a nominee option for the scheme?
Yes, absolutely. All investment schemes have nomination option.
So, in case a person pensioner, passes away in between, it goes to the nominee.
Will go to the nominee.
5 years plus extension of 3 years. After that, should it be closed?
It will automatically be closed, and then at that point in time, whatever is the prevailing rate in the scheme, if the scheme continues, you can start a new scheme with that.
New scheme, new investment,
yeah.
Reinvest. Kind of. Thank you.
Absolutely. So, in case the joint holder or a sole nominee is a senior citizen, then he's eligible to continue and have continue the senior citizen as long as he doesn't have a senior citizen. The idea is the central theme is that this scheme can be availed of only by a senior citizen, not by anybody else. That's the bottom line. And any investment made can be shown as a deduction in the rating scheme. And if the interest is the total interest exceeds 50,000 in a financial year, then the interest amount is taxable. So again, the same numbers on 15 lakhs of investment, you can enjoy about 9,250 of what do you call monthly pension. Of course, this is paid out on a quarterly basis, not on a monthly basis, unlike a thing. But we've given a monthly number because as I started the discussion wanting you to give a monthly number, so I also decided to give a monthly number here. But the payout in this case will happen only on a quarterly basis.
That the scheme you pay at the beginning of the scheme beginning, right? There's no in-between payments that have to go out from our side.
No. These are all lump sum payments. So one time you make this 15 lakh payment, that's it.
Okay.
There is no more cash flow required from your end. On the contrary, you want returns from this, right? So that's the purpose. So you put 15 lakhs into this. You every quarter you will receive 27,750 rupees.
Sir, hello, sir, hello.
Yeah.
Sir, this is Jambunathan. I just want to add one piece of information on about the scheme. Supposing the maximum allowed in this scheme is 15 lakhs. Supposing one has 5 lakhs today, he can open the account with 5 lakhs today. And again, he gets 5 lakhs after say 2-3 months. He can open a second account with that 5 lakhs. Like that, number of accounts, the total amount that can be saved in this scheme is 15 lakhs.
Absolutely.
Yeah, for many seniors, why I am making this small submission is that, sir, for many senior citizens, certain times the provident fund money comes first, then the gratuity money comes, then certain other payments, the leave encashment comes, etc. comes. Therefore, all the money is not received in one single installment, sir. Therefore, for them also to benefit them, government has permitted them to open any number of times. Any number of times, any new account can be opened, but the total should be less than 15 lakhs if it is in single name, or 30 lakhs if it is in joint names of the spouses.
As long as the spouse is also a senior citizen.
Exactly, sir. The spouses should also be a senior citizen, right, sir? Exactly. That is and sir, one more drawback for this scheme, I tell you, sir, right now, is that, see, most of us think that automatically the amount will, after 5 years, automatically the amount will get extended. No, sir. After 5 years, the amount will get credited only to that savings bank account, to which account the monthly interest, the quarterly interest is going. Unless otherwise they reach the branch or the post office and give an application for extension of it up to the maximum period of 3 years. This is very important, sir. And third point is that this scheme is freely transferable between banks and post offices. That's a very, very new recent addition they have made. Therefore, with the same account number, like for mobile phone transfer, this can be done either with the sales bank, either with the banks or with any post office.
That is very useful. This is also an important point, like the sir said, that in case of the overall limit being 15, it's not that you must only open if you have 15. If you have 4 or 5, you can start an account and go ahead with that. The next time you get something more, you can continue to do. You can open as many accounts to reach that 15. The only thing is the maximum limit per senior citizen is 15 lakhs. That's the point. I think that is what he was wanting to make. I think that's a fair point, just to kind of clarify further. So going forward, so we've covered 2 schemes. One is this LIC Pradhan Mantri Vayu Vandana, and the other is senior citizens. And of course, the third one is the post office monthly income scheme. I'm not a great fan of this, given that it's a little bit of a laborious process, but nevertheless, it is one more option for senior citizens to enjoy cash, what shall we say, guaranteed cash flow. And from that perspective, it is a scheme that one needs to look at. The policy tenure is about 5 years. The payment of pension is on a monthly basis. In joint names, this allows for joint names in individuals up to 9 lakhs. Incidentally, this is not just for senior citizens; it can be opened in anybody's name also. But the most often beneficiaries who require a monthly cash flow are senior citizens. So I thought this should also figure here in terms of one of the options that one needs to think. The current interest rate on this is a little lower than what you have in senior citizens and this LIC scheme. Primarily, like I said, those schemes are reserved for senior citizens, so government wants to give a slightly higher push on the rate, whereas here this scheme is open for everybody, anybody and everybody. So therefore the interest rate is much lower. So it's about 6.6 currently, and these rates can continue to change at various points in time. The scheme matures every 5 years, and at the end of 5 years, you get the money back, and kind of if you need to reinvest. And of course, being post office, there is no TDS at this point in time, so you can enjoy the interest. Of course, you are liable to pay tax on this if you're on the taxable slab, but they don't deduct TDS from the payments. And so for the maximum amount of 9 lakhs currently, the monthly cash flow works out slightly less than about 5,000 rupees, so 4,950 every month. So this is one more thing that one can enjoy on a guaranteed, government guaranteed kind of a cash flow basis, which is the objective of today's talk, is without taking any risk. How can I enjoy a certain amount of cash flow and return is what we were, what was the kind of brief for today's conversation, and that's what. So this one more scheme also kind of fulfills that criteria. So I just wanted to kind of bring this to the foray. The next one is what we call, it's actually not RBI bond. It's now called the floating rate savings bond. It used to be in the earlier avatar called the Reserve Bank of India bonds, but now it is called the floating rate Government of India floating rate bonds. Now, this is again not specifically for senior citizens; it's for everybody. And as the name suggests, it's a bond where the interest rates are floating, is not a fixed rate. So the rate is, kind of in some sense pegged to the prime rate. Prime interest rate, so prime interest rates plus a certain percentage. So as and when prime interest rate keeps moving, your rate of interest on this bond also keeps changing. Since it's a government guaranteed bond, there is our belief is that these are risk-free instruments, and the eligibility criteria for this is you must be an individual and you must be an Indian citizen. As long as you fulfill these, you can. One of the advantage of this bond is that it has no maximum limits. So unlike the LIC and the what you call senior citizen scheme, where one had a maximum limit of 15 lakhs, this one has no maximum cap, and there is no number of times you can do. You can do any number of times, and there is no maximum cap, so you can really kind of do whatever you like. And from that sense, it's a good scheme. The not so good scheme from the senior citizen perspective is that interest is paid only twice a year. Half-yearly basis is the interest option. So 30th June and 31st December are the two occasions when one is paid the interest. So there is no monthly option in this, which is something that would have been nice, but no, there is no. So we'll have to be content with collecting our interest on this every 6 months. So it's okay. The bond tenure is about 7 years. There is no renewal option in this. So at the end of 7 years, the money will come back to your bank, and then you can kind of choose to reinvest in the scheme if you have the option at that point in time, at whatever is that prevailing rate. So like I said, the basic coupon rate is based on the National Savings Certificate plus 35 basis points. So currently 6.6 plus 15, about 7.15% is the current rate on this bond. And this is floating, which means every 6 months these rates can change. Interest on these bonds are taxable. If you're on the taxable slab, then you must offer these interests also for tax. So we've just taken a rough number just so that we understand what these numbers look like. So on an RBI floating rate bond, 20 lakhs of investment done every 6 months at current rate will yield you about 71,500 or 1,43,000 on the whole, which translates to a monthly investment of about 12,000 rupees. So just for our understanding, on a monthly basis, like I said, this is only paid out twice, so you will only receive money twice. But we have just shown the monthly option so that you can understand what the monthly implication will be. But you will collect it once in 6 months only. So that is the floating rate bond. This is also a good option for people who have the ability to kind of not require the money for say a period of 5-7 years. If you are looking at a 5-year fixed deposit in the bank or 7-year kind of investment in a bank, this could be a good option. This could be a good option. The only caveat is that liquidity is not available. So typically these on very extreme circumstances, on request, the premature withdrawal is permitted, but otherwise it's not permitted at all. So these are illiquid from that perspective. But if you do have some amount of funds that you don't require for long term, especially at current rates, these investments don't look bad. They're not. They are pretty attractive, especially in the era of 5.5% or 6% of a bank deposit rate. 7.15% of interest is definitely much more interesting, and that too with this sovereign guarantee that it comes with. The last instrument that I'm going to talk about is a little different. It's a little bit more, involves a little bit more energy. These are called PSU bonds, and we deal with PSU bonds, so I thought it's worth kind of mentioning here. These are not common for all senior citizens, I must say. If you have reasonably large corpus that you want to deploy, beyond all this, you've done your 15 lakhs of PMFY, you've done your 15 lakhs of senior citizens, and you've done all the rest, and you still have money to deploy toy and you want to kind of go only to safer zones, then these could be one more option you should look at. Now, these are not entirely risk-free, let me be honest. There is some risk attached to it, and I'll explain that as we go along. Although they are PSU bonds, and here I'm using the word PSU from a point of view of a proxy to the government. A private public sector undertaking is still manned and owned by the government, and to that extent, the guarantee that they offer is the guarantee that the government offers in that sense. Again, these are minimum investment of 10 lakhs, and there is no maximum limit. Many of these bonds have to be bought only in the secondary market. They're not available on primary market. Interest rates are paid either half yearly or yearly. There is no monthly options in these, and interests are taxable. Now, there are these perpetual bonds, which are part of the new banking norms, the Basel III capital norms. So many of the banks do come out, the nationalized banks do come out with these bonds, and the rate of interest are significantly higher than what a similar FD will fetch for you. Right? So a Canara Bank perpetual is a 10 lakh investment, which can get you a 9.8, and these rates keep changing depending on how the market is, so on and so forth. But it's only an annual payout of interest. You don't get a monthly option in this. So similarly, there are lots of bonds that are traded in the secondary market that one can look at. One necessarily needs a demat account to buy these bonds, and these bonds aren't always liquidable. So as the name suggests, these bonds are perpetual, which means that they are meant to be held in the long term. So typically, if one buys these bonds, the exit for these bonds are only twofold. One is either the bank has to come back and purchase it back, or you have to sell it in the secondary market. Now, both of these are uncertain events, and unless you find a buyer for these, so there is a little bit of an uncertainty written towards this. So these are not the safest of instruments from that perspective. You may not find liquidity when you want to. So there are issues around these, so which I want you to kind of be aware of and understand. But yes, from the overall context of different instruments that are available and options available for senior citizens, if you've covered all the basic instruments and still have money to do more, this could certainly be one more option one should look at. That's where I want to position this product for you. Like I said, it has to be bought only in the secondary market. There are primary bond dealers in the second who can help you kind of acquire these instruments, and you must have a demat account. Without a demat, you cannot buy this. So, friends, some of you had given me some numbers to start with. So here I have put out a small working that shows how I can generate a 50,000 rupee per month cash flow on an investment of about 79 lakhs. Now, this is not to say that this 50,000 will happen to me every month, but to say that the 6 lakhs will definitely happen on a yearly basis, and somewhere around 30,000 can happen, or at least 25,000 can happen on a monthly basis. The balance will happen in various cycles, but overall put together, it can be about 6 lakhs per annum. So Pradhan Mantri, senior citizens, post office monthly income scheme, RBI bond, floating rate investments, and of course, I have also chosen the public sector bank bonds, PSU bank bonds, as they are called. These also I have considered for your attention. So these are all current rates. Obviously, some of these rates can change, especially the bond rates are constantly changing on a everyday basis. So I just want you to be aware of it. And so I am kind of going to pause here and open the floor for questions that you may have on this.
So, Mr. Babu, in all these schemes, nomination facility, I hope it must be available.
All the schemes will have nomination.
And in case the subscriber passes away before the, I mean, in between the period, locking period, so what is the thing? Will it be proportionately reduced, or the principal will be handed over to the nominee, or interest will be reduced, or what is the condition?
The principal will be handed over to the nominee. That's all.
That's all.
Simple.
Only the PSU bonds are something that goes above the inflation rate. Am I right?
That depends on what you consider as an inflation. I believe the government is announcing inflation rate to be somewhere around 4 to 5%. So from that perspective, most of these schemes are above it. But yeah, go ahead, sir. What's your question, sir?
The actual inflation rate is 7 to 8. They might say 4%, but actually it's 7 to 8%. So it is. Okay, I'm satisfied.
Why didn't you talk about PPF, this thing, Mr. Babu?
So I didn't talk about PPF because from a senior citizen perspective, my belief is that senior citizens need cash flows.
Right.
So when we start the discussion, you need something on a month-on-month payout. PPF is not that scheme, so I kind of never even came under my radar. I am trying to see how I can generate cash flows, and it's my personal belief, and I could be wrong. You know, a lot of us in our earlier years, we put away money in the long term, saying that when I retire, I want to kind of enjoy. Even after I retire, I don't want to put away money so that somebody else enjoys. I want to enjoy it at that point in time. So that's why I didn't kind of think whether Mr. Vishwanath has asked whether PPF account is still available with tax-free return facility. Yes, up to 2.5 lakhs of annual interest, it continues to be tax-free, sir. Absolutely, you are right. But like I said, I've not covered it here primarily because, you know, while PPF is a good product, it doesn't generate a cash flow to the senior citizen. I believe, you know, if I were 65 or 70, I would want cash in my hands and give it to people or spend on various stuff, right? Rather than it going to my nominees, so on after my time. And looking at the way things are, our kids don't need our money. They are well off by themselves. So it's better to put our money to good use rather than save it for the future. That's my thought. I mean, each one to himself. The purpose of this discussion is not to kind of, I'm not trying to build up a framework that every money should be parked only here. This is a framework so that you decide how much of your principal needs to be in very, very safe place and generate a certain amount of cash flow. So one of the things which I want to kind of give you is that up to 50,000 rupees of monthly cash flow can be handled with reasonable safety. You don't need to take big risks to get this going. Beyond this, maybe you have to try some private FDs, some mutual funds, depending on what your risk appetite is. You may need to go beyond the ordinary. But up to 50,000 rupees a month today, you can enjoy in some form or fashion a government guaranteed return. That's the message that I wanted to leave behind, and hopefully I have done that.
Very good.
Sir, can you be a little more elaborate on this Canara Bank perp?
So I'm guessing that you want to know about the public sector bank bonds. Now, these are all perpetual bonds. So the banks are allowed to raise, as per Basel III norms, all the banks need to raise capital in accordance with the deposits that they collect. And as bank deposits keep going up, these banks will need to increase their capital base. And one of the ways of increasing the capital base is to consider these perpetual bonds. These perpetual bonds, because they are called perpetual, they are considered as equity and capital. So these banks come out with these perpetual bonds, and some of these are very attractive rates. Being PSU and being perpetual, these rates are very, very attractive for normal investors. Now, because they are PSU bonds, we believe they are safe. There is no guarantee per se. These bonds are not guaranteed by the government, but because they are PSU banks and because they are perpetual in nature, and because they are issued by a PSU bank, we believe they are safe. That's the only kind of caveat that I want to leave behind. These are available in the secondary market. So there are secondary market dealers in these bonds who you can approach and buy them. And but you need a demat account. And once you have a demat account, you can buy these bonds. I don't know if all the bonds are traded every day. So you have SBI, you have Canara Bank, you have Union Bank, Indian Bank, all these banks are available. I've just given you a sample. It's not that, Canara Bank is the only bank available. I've just given you a sample of 2 bonds that I saw recently. But all these banks are traded. And because they are secondary market traded, I can't give you for guarantee that this will definitely be available tomorrow morning. But more or less, some bond or the other will be available, which are of nationalized bank. If you have the appetite for it, it's a good idea to go for some of this. Like I earlier said, the only this thing is, it's not liquidity is not guaranteed. So if you need the money back, you'll have to again go back and try and sell. At that point in time, we need to know whether there'll be buyers. Those liquidity aspects still need to be considered. But I'm sure, given at this point in time, there are enough buyers both for buying and selling. So one doesn't have too much of a problem. So I hope this session was useful. Wishing you a lovely weekend, and thank you so much.
Thank you.